I was looking and going through some data from PitchBook. PitchBook did a deep dive on the performance within private asset classes. So this is going to be private equity, it's going to be venture capital, private credit, which is kind of just debt or lending, and real assets. And so next chart that we got that we're going to put on the screen here is the private capital horizon IRRs, or internal rate of returns. And really what this just shows is what were the returns from the start of the year through Q2. So the data is a little bit older over the last 1 year, last 3 years, 5 years, and 10 years. Now, this is annualized figures, not cumulative. So looking at the top chart there, private equity down 1% according to this data source. But if you look over the last 10 years, it's annualized at about 15% per year. And then if you look down, you got real estate annualizing about 7.6% over the last 10 years. But you can see over the last 3 years with the interest rates higher, right? We know that COVID squeezed a lot of juice out of there. That's been an annualized negative 1.5% over the last 3 years. So
yeah.
as
you're
you pulled
looking
out
at these, multifamily, it would look worse than that, right?
Yeah, multifamily. And we're going to talk, also I'm starting to see some cracks in the armor of office spaces too. So as you're looking at this data and you look at the private capital at the bottom there, just as an aggregate basket of just alternative asset classes, what are your thoughts? What are your takeaways?
Well, I believe private capital has to be a part of most entrepreneurs' balance sheet once they get to a certain level of wealth. And it's not surprising. I mean, private equity has led for a lot of the time over the last 30 years, so I'm not surprised about that. And I'm not surprised about real estate. It's been a struggle with the interest rates and the other things that have gone on there. Private capital, important part. I still believe that public equities and public investments also have a part, and the billionaires allocate accordingly. Sometimes I see entrepreneurs that everything is private and crypto, and that's pretty much all they do. And there's value to the public markets. There's liquidity, there is stability. And if we look at stock market performance, it would be on this chart. It wouldn't be the lowest on this chart over the last 10 years, 5 years, 3 years. So that's an important thing to include there too. Any thoughts that you have when you look at this?
Yeah, I think the big thing here is if someone looks at this just from a performance perspective, to your point, I've got the data here that let me find this. So S&P 500 total return is up 205% since December 2019. So that includes the pullback in COVID. The private equity index is up 185%. So the S&P 500 has actually outpaced a basket aggregate of private capital. But like you mentioned, you're getting more diversification when this. Some things are going to zig when other things are going to zag. And more diversification, like they say, diversification is the only free lunch that you've got. You don't want all your assets moving in one direction.
Yeah, and one advantage to private markets is you usually don't know what they're worth and you can't sell them quickly. And the reason why that can be an advantage is because I've seen a lot of entrepreneurs sell their stock portfolio at the worst time and thinking it's never going to come back or it's going to keep getting worse. And boy, it's hard to make those predictions and know when to sell and when to buy. However, I was just talking to one of our entrepreneur clients that that I won't mention, that told me, he said, if I would have just taken all my money and put it in index funds instead of all the stuff that I tried, all the crazy private stuff I tried, he said he did the math and he'd have about 3 times the net worth he has today just by doing that. And that's not a suggestion that you should go out and just buy the public markets. It is a suggestion, though, that a lot of young entrepreneurs, when they have a lot of money, they throw money at private deals and they make a lot of mistakes. So try not to do that piece of investing that a lot of entrepreneurs end up falling victim to.
Yeah, well, I mean, even when we always study the billionaire asset allocations, we always talk about, and we reviewed that on a show in the past, that the public equity still represents about a third of the billionaire's allocation. So boring old Mr. Stock Market is about a third of the portfolio. Yeah. Now, again, a lot of entrepreneurs are maybe told, hey, go to talk to a big wirehouse or a big investment advisor, and they're going to put 100% of your money in stocks and bonds. Well, the billionaires aren't doing that. Again, they're maybe around a third up to 40-50%. So there is a reason that the billionaires are investing a substantial amount of their net worth in alternatives. So it's all about, like everything in life, being in the moderation, right in the middle there.
I think the difference, though, would be that billionaires have a system and a process and a team that vets things, and often entrepreneurs are just talking to their buddy and throwing money in there. So I think there's incredible opportunity in the private markets, but there's also risk of just making dumb decisions where if you can buy index funds and eliminate a lot of the dumb decisions. Whereas with the private markets, you got to know a little bit of what you're doing and you have to have some people helping you. But once you have that, as you said, there isn't any billionaire that I'm aware of that doesn't have significant amount of money in these different areas that are on this chart here.
Yep. Yep. All right. Well, let's keep going. So the next chart we're going to throw up here is the private equity. So from the same data set here, the private equity funds rolling 1-year horizon IRRs, and then also 1 year by size. And really what this shows is just for those listening and not viewing, in 2021, huge spike in the IRRs up to 50% or so on average, and then it kind of really came back down to 0% or so at the end of 22, and then it's been hovering around maybe 10% from there on out. And this was really a lot of nice exits that came out of the COVID boom, because right in 2021 there was a lot of money in the system, interest rates were really low, valuations were really high, so private equity funds really had nice IRRs, or internal rate of returns, as they were selling out from underneath them some of these assets they picked up pre-COVID and during COVID. So that was a big driver there. And then the next chart we're going to throw up here is venture capital fund. So switching asset classes from private equity to venture capital fund. Again, similar chart, but it looks even more dramatic as an even higher spike up in the VCs rolling 1-year IRR, and then a deeper trough there that actually were underwater in late 22 and early 23, and then also some dispersion. And the thing that's interesting about venture capital, I think more so than any of these other asset classes, I was just reading an article on TechCrunch, and it was talking about how a lot of these LPs are now underwriting these VC funds to 15 to 20 year hold periods.
Wow.
Because there's so much illiquidity in venture capital, and the DPI, which is essentially how much money you're getting paid out, is so low that a lot of them are cutting their allocation to venture capital because it's underperformed the NASDAQ. So why would you want to invest in the venture capital if you can get public liquidity, public market exposure, collateralization, et cetera, for, with the same performance? So VC, of all of the different asset classes, I think feels the most stressed right now. Now, the question is why, and some people would say that it's going to loosen up a little bit with the new regime from a White House, because now deal making is back on the table, whereas the previous regime led by Biden and the FTC was really cracking down on, monopolistic or anti-competitive behaviors, and so there wasn't a whole lot of deal making. So then that really hurt, liquidity in the VC space. So it'll be interesting to see over the next 3 years, does VC really come back as an asset class now that kind of the market's open to doing businesses, or doing business, I should say.
I do think it's going to come back some. And I also believe this is one of the riskiest areas for entrepreneurs, because as an entrepreneur, I get more VC startup stuff from friends and other people raising money than I get anything else. And just like we talked about at a recent call, remember when we talked about private equity and how they're getting more pressure for distributions and for giving money back, because more and more investors want to get money back. It used to be just the multi-billionaire family offices were investing in these things, and they don't care if they get the money for 20, 30, 40, 50 years. And with VC, they're illiquid, and you really shouldn't expect any money for years. And it could be 5 years, 10 years, 15 years before you get the exits. So this is an area that especially I think entrepreneurs need to be careful. And also, I'd rather, if you don't know what you're doing, find a VC fund or someone who manages VC money professionally, rather than just trying to pick your buddy's startup that might work for you. And I know for me personally, Mimi and I, as you know, one of the things that have cleared our lives in the last few years is I want to invest in anything that's pre-revenue. So I have a VC fund that we put money in, and that VC manager can make the decisions. But anytime someone comes to me and says, "Hey, Jim, will you invest in my deal?" I say, "Is it pre-revenue?" "Yep, I'm out." And that saved me a lot of time and a lot of money. Not saying that you shouldn't consider things that are pre-revenue, but that's just a place where I am in my life that I don't want to mess around with the pre-revenue deals.
Yeah, I hear you. I mean, and I think venture capital, at minimum, you got to invest in 10 portfolio companies at minimum to get enough at bats to hopefully get one home run there. And I mean, when I look at my portfolio, venture capital is the only asset class that I've got nothing in, because similarly, I don't want to source enough deals. I don't trust enough deals. I've seen too many clients strike out on deals. And then now, as I see more and more of the funds performance, there's really a huge, if you're in the best funds, you can get great IRRs, but a lot of the middle kind of run-of-the-mill funds are really lagging the market, and you don't have the liquidity. So I've stayed away from venture capital overall as an asset class, and I will say I have no FOMO in that one. All right, let's talk through private debt. So private debt and private credit is blowing up. That's been the belle of the ball really since 2022, 2023. In that environment, the Fed really started increasing interest rates as we came out of the COVID cut cycles and free money on the table. Inflation was rampant, so the Fed cut interest rates. Well, Unlike bonds, which took a bath at that time, private credit performed very well because it's generally a floating debt instrument. So usually it's SOFR plus maybe 5 to 6%. So SOFR floats with the interest rate environment. So you were getting 12, 13%, at the high end. And if you're, it depends on what your collateral was. If they were making just investments to different operating businesses, you're probably 12 to 14%. Whereas if you're making loans, the manager's making loans to infrastructure like data centers or to real estate, you're probably closer to 8 to 10%. But private debt's done really well. And then the next chart up on the screen here is just going to show you the rolling 1-year IRRs by the different types. So mezz debt, general debt, direct lending. And you can see that's all over the board, but really kind of hovers in around that 10% space. And the interesting thing is, as you look at this data, it's starting to trend downwards and to the right. And this is becoming a very, very crowded trade. And now, as Jamie Dimon says, right, there's never one cockroach. And so Jamie Dimon's throwing some rocks here at private debt and private credit.
Yeah, I like it as a diversifier for an income source, but I think you got to be more and more discerning about how you're doing that. And one thing that I've seen with entrepreneurs in the last several years when private credit was doing so well or was really leading the pack, as you said, is they're almost acting like, oh, I can get 8 or 10 or 12%, and it's better than what I get in the bank. Yes, of course it's better than what you get in the bank because the bank doesn't have risk and private credit has risk. And I think a lot of times entrepreneurs, especially if they hear it's collateralized by real estate, they're like, oh, there's no risk and I can get a risk-free 8% on my money. And the truth is there is no risk-free 8% on your money. So you need to understand what the risks are and be comfortable with them and then build within the portfolio and your allocation to make sure that all that's being taken into account. It's not just a way you can get 8% with no risk.
So 8%, no risk. Jim, have you heard of infinite banking?
I have. I've heard of infinite banking, cash flow banking, bank on yourself, the LEAP program. I've heard of a few things that are tagged with those kinds of marketing slogans.
Yes, that is a joke. That is an overfunded life insurance policy, which is, I would say, generally oversold to our clients. I would say they don't market as 8% no risk, but I've heard 7% no risk before. So yeah, your comment made me chuckle because if I were an insurance salesman, that would be my response. And we know there's more to the story there.
Yeah, we should spend some time on that at some point. And permanent life insurance is a tool and has its place, but as you said, it's oversold, and often the entrepreneur doesn't really understand these products, and they're buying from the person that brought them the idea who makes a commission for selling the product, and that's a recipe for a problem.
Yeah, I think maybe 5 to 10% of the clients I see that have deployed capital in that don't end up regretting it. So the inverse of that means 90 to 95% of clients who end up purchasing one of those big policies ends up regretting it. So,
yeah, it's unfortunate because there are real reasons for life insurance and its different categories, as well as not for just for asset protection or for things like estate equalization or estate taxes or even replacement of income, or there's tax advantages in using it, for distributions. But to your point, it gets oversold, and often entrepreneurs regret what they did in that space. And it's too bad. It's because they don't have representation and they feel comfortable with this person and all the proposals are great. And then they move forward with something that later they feel like they made a mistake.
All right, let's talk through real estate. So next chart up we're going to show here is real estate index quarterly returns. So you can see this chart at the beginning of the timeline in 2019, up and to the right pretty much besides a COVID blip through the end of 2022. Well, what happened then? The Fed just starts hammering interest rates higher, and now these bars are all down, which means down, 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 down. And again, as interest rates go up, cap rates go up, the value of, assuming you don't increase your net operating income, all else equal, the value of real estate goes down there. So real estate's had a huge run up in COVID, and I think a lot of people have felt that if they've owned real estate coming out of the COVID bubble, they're very happy. But as we know, it's very expensive now. Interest rates are high. A lot of people have been cut out from the market. And the data here kind of shows what the sentiment that is felt.
Yeah, one thing I see with real estate is too often, and this is with any investment, entrepreneurs fail to stress test their investments and stress test their overall allocation and their plan. Because if you were to stress test some of these multifamilies and just said, well, what if interest rates go up 2, 3, 4, 5%? What does that look like with the deal that I'm in? And if they would have stress tested, they would have said that's going to be a problem because a lot of these are variable loans. A lot of these have covenants that they have to meet. And entrepreneurs, many of them didn't do that, and they just believed real estate always goes up and never has a problem. And of course, there is no investment that always goes up and never has a problem.
Yeah. Yep. All right. Last asset class here, real assets. So real assets, think of this as infrastructure. You're going to have oil and gas, different things like that. And then the last chart we've got here just shows oil and gas, infrastructure, metal, timbers, and agriculture. A little bit steadier. Oil and gas is obviously going to be a little bit more variable just because as the price of crude moves around and there's geopolitical risk, that's going to ebb and flow. So during COVID, you can see there's a line light blue for those of you who can't see, down 30%. And that's just because when you're going to a recession, the demand for oil really falls off of a cliff because if trucks aren't driving, if people aren't buying stuff, if we're not moving product around the world, there's not a lot of demand for oil. Whereas when we go to the boom cycle, which you can see oil really ripped up higher to up 40% in 21, 22, that's just because, again, there's a lot more demand for the oil and gas. And that's why we'll talk about this in the future, but diversifying your vintages when investing in oil and gas is very smart. But
yeah.
All else here, this is a little bit more of a diversification play, and you can see these are starting to nestle in around 5 to 10% kind of annualized returns.
Yeah, and it's funny when you mention the oil and gas and the drop in demand during COVID. I remember here in Phoenix, Scottsdale, the air was so clean. You could see from where we are, Camelback, clear as day, because no one was driving any cars. And if you're not driving cars, you're not using gas. And so the demand dropped dramatically, and we had beautiful air here for a few months.
Yep. All right. So that's what's going on in the alternative asset classes, the different actual historical performance here over the last several years, where they're at, where they're going. And again, billionaires have about 40 to 60% of their liquid net worth in these exact asset classes. And so this is a big piece of how the richest and the smartest people in the world are investing their money. And again, I think for a lot of 8 and 9 figure entrepreneurs, it makes sense to also diversify into these different alternative asset classes.